Yesterday afternoon, crypto and banking executives sat across from each other at the White House in what insiders are calling the most tense negotiation in digital asset history. XRP, Bitcoin, the entire stablecoin ecosystem, and your ability to earn yield on your crypto just became bargaining chips in a fight that could reshape American finance. And based on what actually went down in that room, things just got a lot more complicated. This was the second emergency meeting on stablecoin legislation. And unlike the first one, this wasn't a meet and greet. This was a negotiation with real proposals, written demands, and barely concealed frustration on both sides. The White House set a hard deadline of March 1st to reach a compromise. And they're not playing games, but here's what matters to you. The outcome of these talks will directly determine whether platforms like Coinbase, Kraken, and Uphold can pay you rewards on your stablecoins, or whether banks get to shut that down entirely. We're talking about your money and your freedom to earn competitive returns. This isn't abstract policy anymore. This is personal. And by the time you finish this video, you'll understand exactly what happened in that room, what banks are really afraid of, why the crypto industry showed up in force, and most importantly, what's likely to happen next. Because while everyone's focused on the surface drama, there's a deeper game being played that almost nobody's talking about. Let's start with who was actually in the room. On the banking side, you had representatives from Goldman Sachs, JP Morgan, Bank of America, Wells Fargo, Citi, PNC Bank, and US Bank. Add in their lobbying groups like the Bank Policy Institute, the American Bankers Association, and the Independent Community Bankers of America, and you've got the full force of traditional finance. On the crypto side, Coinbase sent Paul Grewal, A16Z sent Miles Jennings, the Blockchain Association sent Kristen Smith, and Ripple sent their chief legal officer, Stuart Alderoe. There were also representatives from Paxos and the Crypto Council for Innovation. Now, here's what didn't get reported widely enough. Crypto didn't just show up, they dominated the room numerically. One source said crypto filled one entire side of the table and wrapped around to the other side. Banks sent a handful of lobbyists. That tells you everything about who's taking this seriously and who thinks they can coast on political connections. The crypto industry came prepared, informed, and ready to negotiate. And according to multiple attendees, they had some of the smartest people in the room. Now, the day before the meeting, attendees got an email from the White House that essentially said, "Come ready to make real proposals and be willing to compromise. No more posturing." The White House wasn't interested in another round of talking points. They wanted movement, and that pressure worked, at least partially. For the first time, banks came with something concrete, a written document titled Yield and Interest Prohibition Principles. This wasn't a suggestion. This was a list of demands. If you found this breakdown helpful so far, go ahead and tap that like button because we're about to go deeper into what those principles actually say. And trust me, you're going to want to pay attention to this part. Here's what banks put on the table. First, a total prohibition on stablecoin yield. Their exact language. No person may provide any form of financial or non-financial consideration to a payment stablecoin holder in connection with purchase, use, ownership, possession, custody, holding, or retention of that stablecoin. That's not a narrow rule. That's a blanket ban. They want to make it illegal for any platform to give you anything of value just for holding stable coins. No rewards, no interest, no cashback, no incentives of any kind. Second, they added that any exemptions must be extremely limited so they don't undermine the prohibition. Translation, if there are loopholes, they need to be so narrow that nobody can actually use them. Third, they want regulators to have enforcement power with civil monetary penalties. They don't just want a rule, they want teeth behind it. And fourth, they included anti-evasion language, meaning companies can't get creative and structure around the prohibition. They thought of everything. But here's the line that matters most. And this is what most people missed. In paragraph 2 of their document, banks included the phrase, any proposed exemption. That's new language. In previous discussions, banks refused to even talk about exemptions. Their position was absolute. No yield, no exceptions, no discussion. The fact that they're now using the word exemption signals that they know they're going to have to give ground. It's a small crack, but it's a crack. Crypto negotiators noticed it immediately, and that's what gave them hope that a deal might actually be possible. Stuart Alderoe from Ripple walked out of that meeting and posted on social media, "Compromise is in the air." He wasn't being optimistic for no reason. He saw that opening. But don't let that fool you into thinking banks are being reasonable, because when you peel back their arguments, the whole thing falls apart. Banks are claiming that if crypto platforms can offer yield on stable coins, depositors will pull their money out of traditional banks, especially community banks, and move it to Coinbase or Kraken or wherever they can get better returns. And if that happens, banks argue they won't have enough deposits to make loans to small businesses and families. No loans for homes, no loans for cars, no loans for Main Street America. That's the fear they're selling. It sounds compelling until you ask one very simple question. Is that actually true? Let's be honest about what's happening here. Subscribe to the channel if you haven't yet, because we're covering every twist and turn in this fight, and you're not going to want to miss what happens next. Banks aren't worried about community lending. They're worried about their profit margins. Right now, most banks are paying you close to nothing on your savings account. We're talking fractions of a percent. Meanwhile, they're taking your deposits and lending that money out at much higher rates, pocketing the difference. That spread is their business model. If you move your money to a platform that pays you 3, 4, or 5% yield on stable coins, you're not hurting Main Street. You're just choosing a better deal for yourself. And banks hate that because it forces them to compete. They'd rather keep paying you almost nothing and keep the profits for themselves. That's what this is really about. They don't want to raise their savings rates. They don't want to offer competitive products. They want the government to eliminate the competition. Here's what makes this even more frustrating. Banks had their chance to fight this battle during the Genius Act negotiations, which dealt specifically with stable coin regulation. They chose not to engage. They sat on the sidelines. Now that the Clarity Act, which is about broader market structure, is moving through Congress, they're trying to hijack it with stable coin yield provisions that have nothing to do with market structure. Multiple people in the crypto industry have pointed this out publicly. One executive said both sides should stop relitigating Genius. That battle was fought. If you don't like Genius, amend it. Market structure has nothing to do with yield on stable coins and must not be delayed further. That's a direct shot at the banking lobby for holding up progress on an entirely separate piece of legislation just to get their way on an issue they already lost. And here's the thing banks aren't telling you. This prohibition wouldn't just hurt crypto platforms, it would hurt you. Let's say you hold USDC or USDT on a platform that currently rewards you for keeping your funds there. Maybe you're earning a little cash back when you spend it. Maybe you're getting a small percentage return just for holding it. Under the prohibition banks are pushing, all of that goes away. Not because it's risky, not because it's unregulated, but because banks don't want to compete with it. They want a law that protects their outdated business model instead of innovating to serve customers better. That's not free market capitalism. That's crony capitalism. Now, let's talk about what happened when this all reached the House of Representatives, because this is where things get really interesting. The House spent 3 and 1 to 2 years working on the Clarity Act. They went through committee hearings, markups, revisions, and negotiations with both parties, and when it finally came to a vote, last July, it passed with massive bipartisan support. 78 Democrats voted for it. That's not a handful of moderates crossing the aisle. That's a significant chunk of the Democratic caucus saying, "This is good legislation and we support it." The bill included provisions on stablecoin yield and DeFi protocols, and both sides found language they could live with. It wasn't perfect, but it was workable. That's called compromise. Then the bill went to the Senate, and the Senate, specifically the Senate Banking Committee, decided to change things. They started tweaking language, adding provisions, narrowing definitions, and turning what was a bipartisan bill into something that made almost nobody happy. The crypto industry started raising red flags. Democrats who had supported the House version started backing away. And now, months later, we're stuck in this stalemate where the White House is hosting emergency meetings to try to salvage something that was already working. Representative French Hill, who chaired the House effort, said it bluntly. We did that in the House, and therefore our language, our bipartisan language, is the place to land in the Senate. We've demonstrated bipartisan support. He's basically telling the Senate, stop overthinking this and pass what we already agreed on. But the Senate doesn't seem to be listening, and that's why the White House is stepping in. Patrick Wick, who's the executive director of the President's Economic Council, and essentially the administration's point person on crypto, is now personally brokering these negotiations. After yesterday's meeting, he posted, "Big thanks to yesterday's participants from crypto and banking industries. We're going to get it done. That's a public commitment." He's putting his reputation on the line. And Brad Garlinghouse, the CEO of Ripple, went on camera and said he's now 75% confident that the Clarity Act will pass by the end of April. That's a pretty specific number. He's not just guessing. He's hearing things from people in the room. Now, if you're still with me, I want to hear from you in the comments. Do you think the Clarity Act should allow crypto platforms to offer yield on stablecoins? Or do you think banks have a point about protecting deposits? Drop your take below, because this is one of those debates where reasonable people can disagree, and I'm genuinely curious where you stand on this. Let's build that discussion. Here's where things took an unexpected turn. During all of this chaos, the CEO of Barclays, one of the biggest banks in the world, went on Fox Business and said something that probably made his industry peers very uncomfortable. He said banks need to adopt Bitcoin and crypto immediately, not eventually, not after more research. Now, he was asked directly about the competitive threat from crypto platforms and whether banks should be worried about fintech companies offering better yields and better user experiences. And instead of defending the old guard, he said fintech companies have made the user experience really good. They've taken pain points out, and they've made it easy for people to move money. Then he said this: crypto and stablecoins are an important part of the new digital asset platform, and it's important for banks and fintech companies to work together in a proper regulated way. That's a massive statement. This isn't some small regional bank trying to stay relevant. This is Barclays, a global financial institution, saying the future includes crypto, whether traditional banks like it or not. And when the host pushed him on whether crypto platforms should have the same regulations as banks if they're going to compete, he didn't dodge. He said there needs to be balanced regulation that allows for competition while protecting consumers. He didn't call for prohibition. He called for adaptation. And that's the attitude that's missing from most of the banking lobby right now. They're fighting to freeze the market in place instead of evolving to compete. Because here's what's really coming, and this is what banks should actually be worried about. This fight over stablecoin yield is just the opening act. The main event is DeFi, decentralized finance, and it's going to be brutal for traditional banks. Right now, if you need a business loan, you go to your local bank, fill out paperwork, wait for approval, and hope they give you decent terms. In 5 to 10 years, you're going to go to a DeFi platform, connect your wallet, provide collateral, and get a loan instantly with transparent terms set by a smart contract. No loan officer, no waiting, no arbitrary decisions. The same goes for mortgages, auto loans, personal loans, everything. DeFi protocols are coming for every product banks currently offer, and they're going to do it faster, cheaper, and more transparently. That's the real threat, not whether Coinbase can pay you 3% on your USDC. That's a distraction. The real war is whether banks can adapt fast enough to survive the next decade of financial innovation. And here's the irony. By fighting so hard to protect their current business model, banks are accelerating their own obsolescence. If they spent half the energy they're putting into lobbying against crypto into actually building competitive products, they'd be in a much stronger position. Offer higher savings rates, build better apps, make it easier for customers to interact with you digitally. Stop acting like it's 1995. The Barclays CEO gets it. His US consumer bank is almost entirely digital, with no physical branches, and they're thriving. That's the model. But instead, most banks want the government to kneecap the competition so they don't have to change. And that strategy might work for a few years, but it won't work forever. So let's talk about what's probably going to happen next. Because based on everything we know right now, there are a few likely scenarios. First, the negotiations continue behind closed doors between now and March 1st. The White House keeps applying pressure. Crypto and banks keep talking, and eventually they land on some kind of compromise that nobody loves, but everyone can live with. That compromise probably looks like very narrow exemptions for yield. Maybe platforms can offer rewards only on certain types of transactions. Maybe there's a cap on how much yield can be paid. Maybe there's a registration requirement that puts crypto platforms under similar oversight as banks. It won't be perfect, but it'll be something. Second scenario, they don't reach a compromise by March 1st, and the White House decides to move forward anyway with Senate leadership. They strip out the most controversial provisions, pass a narrower version of the Clarity Act that focuses on market structure, and punts the stablecoin yield question to a future bill. Crypto gets some wins, banks get some wins, and the fight continues. This is actually pretty likely because Congress is very good at kicking difficult decisions down the road. Third scenario, and this is the one that keeps me up at night, the whole thing collapses. Banks refuse to budge. Crypto refuses to accept a total prohibition. The Senate can't find 60 votes, and the Clarity Act dies. If that happens, we're back to regulatory uncertainty, enforcement by the SEC and CFTC without clear rules, and the US falls further behind other countries that are building sensible frameworks. That would be a disaster for the industry and for everyone who's invested in crypto's future. But here's what I actually think is going to happen. The Clarity Act passes probably by late April, with some form of limited compromise on stable coin yield. It won't be everything crypto wanted, but it'll be enough to unlock the next wave of institutional investment and development in the US. XRP will benefit, Ethereum will benefit, every major blockchain project will benefit because there will finally be regulatory clarity on how digital assets are classified and how they can be used. And once that happens, the floodgates open. We're talking about tokenized securities, regulated trading platforms, institutional custody solutions, DeFi protocols operating legally in the US, and traditional finance companies finally comfortable entering the space at scale. That's the prize everyone's fighting for, not just stable coin yield, the entire future of digital assets in America. And here's the part banks don't seem to understand. Even if they win the stablecoin yield fight, they're still going to lose in the long run because the technology isn't going away. Consumer preferences aren't going to reverse. The world is moving toward programmable money, peer-to-peer transactions, and financial services that don't require a middleman taking a cut of every transaction. You can regulate it, you can slow it down, but you can't stop it. This is banking's blockbuster moment. Remember when Blockbuster had the chance to buy Netflix and passed because they thought people would always want to rent physical DVDs? That's what's happening right now. Banks are clinging to a model that's dying while the future builds around them. Some will adapt like Barclays seems to be doing. Most won't. And in 10 years, we'll look back at meetings like yesterday's White House negotiation and realize we were watching the old guard fight a battle they'd already lost. If you want to stay updated on every development in this story, make sure you're subscribed to this channel because this is far from over. We've got the March 1st deadline approaching, we've got Senate votes coming, and we've got the crypto industry mobilizing like never before. This is history happening in real time, and you're watching it unfold. I'll be here covering every meeting, every vote, and every twist until we finally get the clarity this industry deserves. Thanks for watching, and I'll see you in the next.